Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny.
And we did a video last week about how the stock market 10 years of returns may not be great. And we said that we're going to kind of take a look at real estate versus REITs versus staying in the market versus large cap dividend stocks and then Chinese growth, which is impossible to look at. It's completely theoretical. So we're going to take a look at that right now. Let us know what you guys think.
Two stupid guys, trade stocks.
Okay.
Boom.
Yeah. So,
Love it.
what is the best option for the next 10 years is what we are trying to decide. Now, full disclosure, we don't know. This is physically impossible to answer. What we're going to do is look at past performance, also trying to see if there is a bunch of volatility, meaning crazy up years, crazy down years, that kind of stuff. And if REITs are worth it over real estate exposure, because we don't ever talk about real estate on this channel. This is almost purely stocks. I actually do some, but I've just fallen into it on accident. So I don't feel comfortable talking about it. But we're gonna talk about it.
I like
All
it.
right. What's this?
Yeah. So this chart is super important. This is the Shiller PE ratio, which is a market cycle normalized PE, and then predicting next 10-year returns of actual realized returns compared to like the Shiller PE at the time of entry. And that red arrow indicates approximately where the Shiller PE is in the market right now, meaning that according to this, if that historical trend line follows through on the scatter plot, as you can see, it's some numbers are all over the map there. But if the trend line were to be an accurate representation of the next 10 years, we'd be basically looking at no real returns for the next decade, which is scary to think about.
Right. Because essentially, we also showed a graph on Apple how it just didn't move for 5 years. It's very possible that's what happened. So, where's the best place for your money? Now, there's a caveat here. If the interest rate were to stay this high, can't really go wrong with CDs or just collect interest. So that's out because we're assuming the rates are going to go down in the next 2 years. So that is not a possibility that we looked at. So here's the options. As we discussed, full disclosure, we're not going to look at Chinese growth stocks. Me and Vinny both have them and believe in that. It's completely theoretical. There's nothing that
Yeah.
we can say with any solid data point that this is a good idea. It's just, it looks like a good art opportunity. So
Yeah.
it's pointless.
I like the
All right.
stock. With Roaring Kitty, right? I like the
Yeah.
stock.
I like the, seems good. So this is this is Tempe, I think, or Maricopa. So I bought a house in 2011, and what we did was I looked at the actual data of price per square foot going all the way up to now. I could only get the data from 2016, which was kind of a
Okay.
bummer. This is not Tempe though. This is, I believe, this is Phoenix. There's a lot of cities. They're all the same. It doesn't matter.
Yeah. Yeah.
Yeah. So essentially, you can see that yes, the housing crisis, which is happening, has been increasing prices in the house, but it has been increasing fairly steadily over 6 years. Now, I do have another graph going back to 2011 of a completely different area. The problem is, if you're not in Arizona, which I am, this is kind of meaningless to you because real
Okay.
estate is very area specific. Okay.
Yeah.
But for me, I bought a house here. So let me move your face. This is hard to do, both of us. All right. So here's the details of the house compared with the stock market, and we're going to compare it to dividends and REITs. All right.
Uh-huh.
So
Okay. I like
purchase
it.
the house for 118,000 with 5,000 down. First time home buyer rule, only 3.5%. All right.
Yeah. $118,000 house. I mean, granted, this is many years ago, but would
Yep.
basically get you like a shed where I live.
Yeah. I mean, it was, so to be clear, I bought at the exact bottom of the market, not on
Nice.
purpose. I cannot stress enough, I had no idea what I was doing. Pure luck. I want to make sure people know that. No, I cannot give any advice. I don't know. But it's currently worth $500,000. It went up 323% since August 2011, plus years of cash flow for the last 3 years, which we're going to take a look at. Now, the SPY, this is with dividends reinvested. Okay? 354% since August and 765% since August Q's 2011.
Yeah. Bananas, that triple Q number.
Yeah, pretty gross. Oh, actually, hold on. No, that was not dividends reinvested. Sorry, that's not
Full
dividends.
SPY?
Yeah, no, neither. It's not dividends. The dividends reinvested are adjusted because it's kind of different. I was trying to give a solid representation of the house. When you charge rent for the house, you get the money routinely, and you can do whatever you want with it. Whereas dividends, you have to buy the stock back. So technically, there's an action. So I want to give both numbers. So the previous one, 354 and 765, no dividends. Then with dividends, 493, 910.
Jesus.
Okay, this is not adjusted for CPI. Now, here's the total investment. So I bought a house, 118,000, 5,000 down, but 20K of improvements because it looked like it was straight out of Saw 5. It was terrifying. Like there was just straight up a hole to the outside to the street. So not good. I had a total of 25K. So that would be my risk in this sense. All right.
Yeah.
Home value, 323% to 500K. But here's the thing. I'm changing the rules because I lived in this house while also charging rent. But had this only been a rental house, which it is right now, you would have gotten about 126 to 130,000 in rental income. Okay. I got that number by taking the 7 years at the lowest value of houses nearby that were the same model for rent, and 5 years at the highest because it slowly went up. But when you look at the median, it's quite close. So mortgage after 10 years would be around 90K because you pay a bunch of interest up front. And then I had 16K in repairs, yada, 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 bunch of words for $520,000 total from my 25K investment if I were to sell the house.
Yeah, so like your cash on cash return, is that what you're trying to get at there?
Yep. So if I were to sell the house right now, 25K to 520 would be a 1,980% return.
Nice.
Pretty dope. So SPY, dividends reinvested 493, Q's dividends reinvested 910. So I will say this is at the bottom of the market. This is very lucky, right? This is a slightly different area, but once again, all I'm trying to show, this is back to beginning of 2010. If you look, it was still steadily going up. It was fairly safe of an investment over the last 15 years. It's not like you're having dips and dives like the stock market. It's just increasing. All right? So, what's up?
You're doing like a 3-month return there, though. So like this smooths out the volatility a little bit in the market. You know, you're not calculating it daily, right?
Well, yeah, but I mean, if you're in stocks for the long 10 years, you're not looking at it daily. You're gonna have bad days. You know, good days. So November 2021, I bought another house, 65K down. Just since then, the house is now 14% higher. Qs are 17% higher. SPY is 14. However, because of the nature of real estate, it is a leverage bet. So if we were to sell the house, I would have made over 100% already.
Yeah,
on the cash.
On your initial cash investment.
On the initial cash, 65K.
Yeah.
So what's the best thing to do here? So I thought this was going to be better, full disclosure. The REITs were fairly disappointing, okay? The problem with the REITs is there's not like a SPY of REITs. It's very subjective. There's not a SPY or a Qs. There's areas. There's like the largest cap healthcare, largest cap residential, right? So I took Prologix and AMT, which is just some of the largest caps there was. You can see it did beat the SPY, and this is adjusted for CPI, by the way. It did beat the SPY going back about 15 years. Did not beat the Qs, wasn't even close. And then the other VTR, this is healthcare, and EQR is strictly residential. Not even
Okay.
close. Not worth it.
Interesting.
It was
I mean,
actually
one
quite
I
disappointing.
have owned intermittently in the past was Simon Property Group, which is like the largest mall REIT.
Yeah.
Which was interesting.
There's the problem. There's a ton of different REITs. So now you're like, you can just do no research and put it in the SPY or
Yeah.
Qs or do a bunch of research. And then you could get hit because Simon Property Group had some real shitty growth after a bunch of malls started closing.
Yeah. Pandemic.
Yeah. Now, this one was worse. So this is dividend stocks. Now, you can choose any dividend stock you want. I wouldn't recommend a 15% dividend because, yes, there are those, but they're usually hella risky. But
Yeah.
you could look at going back from the same time, 234 versus 463, like Verizon, 20%. Just nothing.
Yeah.
Coca-Cola, 74%, J&J, 108. AbbVie was great at 438, but once again, if you chose the wrong one, rather than having broad, what am I trying to say? Broad
Exposure, I
exposure.
guess.
There we go.
Yeah. Yeah.
It's just risky.
Yeah, AbbVie, you don't buy for the dividend, in my personal opinion. You buy for the product line.
Yeah,
Yeah, because I mean they are dominating in their market segment as far as
they
the
are.
drugs they produce. But that you have to be investing in them because you chose that stock in particular, not just because you happen to be a dividend investor that fell into that stock. I would say.
100%. Yeah, they do have a decent dividend, which was actually kind of surprising. But like Coca-Cola, Verizon, they never move. So theoretically, and in a market that never moves, you might as well go the dividend is what I was thinking. But the SPY has a dividend, and if there is movement and Schiller is wrong, phew, you would have missed
Yeah.
out on a hell of a lot of gains over the last 10 years. I've been very upset.
Yeah.
So in my opinion, time in the market and real estate, yes. REITs, you can get lucky, but it turns into more gambling, and then exposure to large caps did not make sense to me.
Yeah.
Do you see the REIT that is up like 1,000% in like 2 weeks?
No.
It's something. If I just type this in, it'll come up. It's something ridiculous.
Yeah.
Um,
REITs are interesting, but you really are. How do I put this? You have to have some level of expertise, I think, in that individual niche to make it make sense. I did the Simon Property Group as a post-pandemic play was my thought process there, and it worked out fine. It's a trade I kind of closed and haven't looked back at since. I know ticker symbol O is a really popular one. It's a Realty Income. They because they pay monthly dividends. That's why people love them. Or attracted to them.
so that's cool. To me, it just doesn't make sense to do the risk because you could have a risk of, like, I'm sure I should have looked at this. I'm sure there's some San Francisco REITs that aren't doing a great time right now. That before COVID, you'd be like, this is gonna kill it. Super stable, like 15% gain every year.
Yeah.
But until that happened, so not ideal. But
Yeah.
time in the market. Also, most of the comments were time in the market at real estate in China. So we agree.
Yeah, right. I mean, I guess we've curtailed our audience to basically become a sounding box and agree with us on everything.
That's not good.
Don't disagree.
That's bad. That's all right. I'm going to get called an idiot for something I talked about in the houses. So, full disclosure, I don't know. It just happened. All right, have a good one.
Catch you next one.